In the world of investing, there are two primary approaches: short-term speculation and long-term investing. Short-term speculation seeks to capitalize on rapid market fluctuations, often involving frequent buying and selling. Long-term investing, on the other hand, focuses on the steady growth of investments over an extended period, typically years or even decades. While the allure of quick profits can be tempting, history has consistently demonstrated that it is the patient and disciplined long-term investor who ultimately reaps the most significant rewards. Long-term investing is not about chasing the latest hot stock tip or attempting to time the market. Instead, it is about identifying fundamentally sound companies or investment vehicles with long-term growth potential and allowing them the time to compound in value. This approach recognizes that markets are inherently cyclical, experiencing periods of both growth and decline. However, over the long term, the overall trajectory of the market has historically been upward. One of the most compelling reasons to embrace long-term investing is the extraordinary power of compounding. Compounding is the process by which your investment earnings generate even more earnings over time. When you reinvest your dividends or interest, those earnings are added to your principal, and future earnings are then calculated on this larger base. Over time, even small initial investments can grow exponentially. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, becoming larger and larger. This is analogous to the power of compounding. The longer your money is invested, the more time it has to snowball and grow significantly. It is crucial to understand that investing in the stock market inherently involves volatility. Prices of individual stocks and the broader market as a whole can fluctuate significantly in the short term, driven by a multitude of factors, including economic news, geopolitical events, and investor sentiment. Short-term investors often find themselves caught in a cycle of reacting emotionally to these fluctuations, buying high when the market is euphoric and selling low when fear takes hold. Long-term investors, however, are better positioned to weather these market storms. By accepting volatility as a natural part of the market cycle, they can avoid making rash decisions based on short-term fluctuations. Instead, they can focus on the long-term growth potential of their investments, riding out the inevitable ups and downs along the way. Section 4. The pitfalls of short-term thinking, a recipe for underperformance. Short-term investing, also known as market timing or day trading, is fraught with risks and often leads to subpar returns. Market timers attempt to predict short-term market movements, buying and selling frequently in an effort to beat the market. However, consistently timing the market accurately is extremely difficult, even for seasoned professionals. Moreover, short-term trading incurs significant transaction costs, including brokerage fees, commissions, and taxes, which can erode any potential profits. These costs are magnified by the frequent buying and selling inherent in short-term investing. Studies have consistently shown that the vast majority of individual investors who engage in short-term trading underperform the market over the long term. Section 5. Patience and consistency. The long-term investor's best allies. Patience and consistency are paramount virtues for long-term investors. It is essential to remember that building wealth through investing is a marathon, not a sprint. There will be times when the market tests your patience, experiencing periods of stagnation or even decline. However, it is during these challenging times that the importance of discipline and a long-term perspective becomes most apparent. Consistency in investing involves regularly contributing to your investments over time, regardless of market conditions. This disciplined approach, often referred to as dollar-cost averaging, helps to mitigate the impact of market volatility. By investing a fixed amount at regular intervals, you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost basis over time. Section 6. Charting your course. Practical tips for long-term investing success. For those seeking to embark on the path of long-term investing, here are some practical tips to guide you. Define your financial goals. Clearly articulate your financial objectives and invest accordingly. Create a diversified portfolio. Don't put all your eggs in one basket. Diversify your investments across different asset classes, such as stocks, bonds, and real estate. Start early and invest regularly. The earlier you start investing, the more time your money has to compound. Establish a regular investment schedule and stick to it. Keep costs low. Minimize investment expenses by opting for low-cost index funds or exchange-traded funds, ETFs. Seek professional advice. Consider consulting with a qualified financial advisor to develop a personalized investment plan tailored to your specific needs and risk tolerance. By embracing the principles of long-term investing, exercising patience, and remaining disciplined, you can increase your chances of achieving your financial goals and securing your financial future.